Welcome back to Everything Money. If you're new to the channel, this is the show. I am Seth, a standard normal guy. Been a wedding photographer for the past 10 years. I own another business with a partner. I bring your questions. You've been wondering, what do rich guys do with their money? What do wealthy people, how do they get wealthy? How do they stay wealthy? And what do they do with their money once they are wealthy? I have two fellows next to me, Paul and Mo. They both manage tens of millions of dollars. They have houses in Mexico and in Turks and Caicos, Paul. We have to talk about that on the live
stream. Yeah, we haven't bought it yet, but we'll be buying it here in a couple of weeks.
And so I bring your questions about how did we get to how can I further myself, grow wealth, invest smartly. All these happen on this show. And today we're talking about, Paul, this family tree-ish of
I love it.
Value investing. I'm reading more and more about famous value investors. Sir John Templeton, obviously Warren Buffett. I've emailed some that are still alive. And
did Warren Buffett respond to your email?
Not quite yet, but he'll be there. I'm hit him up on Instagram. You
hit him up on the gram. Got it.
But there is this hierarchy that seems to all have started with this guy named Benjamin Grant. Now I've heard the name been thrown around 100 times over. It was a big influence on Warren Buffett, and obviously people have flocked to Warren Buffett for the past 40 years.
Yeah, they just don't listen to him.
That's true. But who is Benjamin Grant, and how has he transformed your life?
So he is considered the father of value investing. He was Warren Buffett's biggest influence. So he wrote two great books, Security Analysis, which, do you want to go to Mo's camera? Mo and I both read with Gary Mashuras leading us. It was the most excruciating read of our life.
This was rough.
And Gary's read it 3 times. And I'm like, there's no way I'm reading that thing 3 times.
This was first published in 1934. I'm sure the vernacular and words are kind of dry back and then very...
I've had to, there were times when 2 pages took me 20 minutes to read. Because you're reading them over and over and over again saying, how do I understand this?
Yeah.
And then his second most famous book is The Intelligent Investor, Paul, 1949.
Also can be a little dry, but there's a great version by Jason Zweig of the Wall Street Journal where at the end of every chapter, he gives a recap in present day terms discussing it. It's wonderful. It's great. There are a few chapters in there that are more noteworthy. Read them. Read The Intelligent Investor. Don't spend your time on security analysis. I think Gary's intention of security analysis was to kind of gauge who here is serious about value investing.
This is a weeding out process.
Yeah, it's a weeding out process for him. He gives you the worst book, and whoever runs through the 550 pages, it's like 700 some pages, but of actual reading is 550 pages.
This thing took like 6 months to get through.
Yeah, it took me about 5 months. I started in January of 19, finished it in May. They're great books. Now, Ben Graham's style was about finding value. And not really, he wanted to find basically like cigarette butts. Like what company has the last puff out of their company? What can sit there and where can I invest to sit there and say, hey, this company might be dying, but there's assets here that are bigger than liabilities and bigger than the company value I can make money on. That's a lot different than my investing style, even Warren Buffett's investing style today. But it provided the foundation of a thought process, right? Mm-hmm. The thought process is finding value. Value can be found in many different ways. Value can be found with you buy a company for $1 and the net assets are $5. Or it can be found the more present day version of, hey, let's go find companies that people think are dead and dying, but actually have a lot of potential still, or are just an exaggerated death and dying because they're not growing fast, like we get accused of all the time.
Yeah.
Go find those companies that still have growth potential. That's more of the Philip Fisher way, but Ben Graham provided the foundation. Seth, you brought the family tree.
Yeah.
There are people out there who literally believe that Warren Buffett is lucky. And Warren Buffett's response to them is say, listen, if you have 100 million investors out there, yes, a few will beat the market and have my returns. The thing is, all the ones that have my returns all came from the same value investing tree of Ben Graham.
Yes.
He's like, at that point, you can't sit there and just say that's a fluke, that's a chance. If they all came from the exact same methodology and teaching, you've got to sit there and say, wait a second, maybe that methodology works.
There's something to it.
I bet you every single day of Ben Graham's life, he was told he was wrong. When times were bad, he was told he was a genius. When times were good again, he was wrong. This happens over and over and over again.
If you're new to all this, like value investing, Paul, this took me a long time to figure out as a normal person. But the idea of value investing is we want to buy $1 for far less than that. Now, unfortunately, nowadays is we have hype YouTubers, we have overhyped stocks, we have talking about pre-revenue and future PEs, where we're trying to buy $1 for like $10
because we think
future profit, because we think something's going to happen. Your key, what you've been advising me for many years now, is just let it happen. Let these companies develop. Stop chasing dreams of millions in the future, and just just find these great deals. And so how did this tree form? Warren Buffett, how did all this happen? And why is this guy so famous?
So Warren Buffett's theory is that you either get it or you don't. You hear about value investing and it immediately clicks with you or it doesn't. That's what happened with me. But I don't know if that's what happened with Seth. Seth here fought me on it for a long time, still does to a certain extent, but I hear him say things now. And when I say fight, I don't think he wasn't really fighting me about it, but he was like, but Paul. But now you hear Seth say things, he's like, yeah, why would we ever do that? It's like, boom.
Well, we've done videos, folks, who are like, why would Tesla not be $1 billion? Why would it not go up? But sure enough, it's gone through
Seth,
phases where it doesn't.
You're a PhD in chemistry, so you like evidence. So when I start showing you these things, you start going, oh, when I show Seth the numbers behind it, well, Seth, let's give me my assumptions. What's the growth? Oh, shoot, I didn't think about it that way. So things speak to everybody for different reasons. We've had a lot of viewers go, you were absolutely stupid and wrong, Paul.
Yes.
Then we have other viewers who say, Paul, you're a god. And all these things, I'm just like, come on, I'm not a god, but thank you. And I sit there
You're
and
a body of a god.
I do.
Really?
I am chiseled. There's going to be different ways that things speak to you. If value investing doesn't speak to you, hey, more power to you. That doesn't bother me. But you cannot fight the history of the results of Ben Graham and his students and followers.
If you don't know if any of this speaks to you, you just follow along. This will take some time. It's taken me years to sort of understand this idea. But yeah, that's right, Mo. But in principle, is like, if you're watching other videos and you're new to investing and they give these price predictions, just keep asking yourself, why? Why would these random IPO companies, these random EV companies, why would they go up? If you're not following along with the math, maybe this resonates with you, and Paul's going to show you why.
So when it comes to Ben Graham, I'm going to do my version of Ben Graham, how I apply it to the companies today, right? So like I said, he was focused on fixed assets because back in the day, most companies had fixed assets. They were manufacturers, there were trains, all these things that had fixed assets, land, building. Our society has changed in terms of how we operate business. We're much more of a service-oriented society. It takes a lot less fixed assets now to make money. So this is how I apply it. You have two companies here. One is growing big time. One is the same. If I showed this to the average person and said, which investment would you rather have? They would say, this one.
Yes.
Of course, that's not the right answer. Let me ask this question. If this was the next 5 years of the company and then it was zero, then it went to nothing. It shut down. So these are the next 5 years of cash flow. What would you pay for this company? How much is here?
$15.
So you have $15 in profit here to mess with, and you have $5 here. So 3 times more, okay? Would you pay $1 for this?
The lower one, yes.
Absolutely.
Of course.
Would you pay $1 for this?
Naturally.
Of course. Would you pay $15 for this?
Not so much.
Exactly. Why not? Seth, this company is growing like crazy. Look at this growth. This is the thing that people miss.
Yep.
They sit there and see this growth. Instead of thinking to myself, how much am I willing to pay for growth? They pay whatever price it takes. You might sit there and say, no, they don't. Yes, they do. Yes, they do. And this is the whole goal here. Am I willing to pay $5 for this? Probably. Why? I'm going to invest $5 and get 15 back in the next 5 years. Why would I not want to triple my money in 5 years? Would I pay $2 for this? Probably. Paying $2, 5 years later, I get 2.5 times my money. What's that return? 25%, whatever the number is. The whole point is it's all about the present value of all your future cash flow. Am I paying more for the faster grower? Absolutely. But am I going to pay too much? No, I'm not going to do that. Because in this situation, I'd rather buy this company. Why would I want $10 to become 15 when I can buy 2 to become 5? The average person out there who is not you, who is stupid, will say, well, Paul, this is $5 in profit. This is $3 in profit. So this is more. No, it's not. This is 2.5 times your money. This is 1.5 times your money. Right? You're getting a higher return on investment down here. Less out, but also way less in. And that's what matters, is your return on investment. What annualized return, that's the key to value investing, is paying as little for future cash flow as possible. Whether that future cash flow is big, small, whatever it is, stagnant, heck, let's do it this way. Ready? We'll do it this way. Let's do the exact analogy. Let's do this one, Seth. 5,
4, 3, 2, 1.
4, 3, 2, 1. Now in this situation, the average person would sit there and say, well, this is growing. right? This is declining. They're the exact same profit levels, $15. Now, it's a lot easier because we know the future is the company ends at the end of 5 years. So you should pay the exact same amount for these companies. What if you didn't know the future? What if you didn't know it was going to end or something like that? Would I pay more or less for this? I'd definitely pay way less for this one. Even though the total amount of profit is the exact same, this one's declining. I'm not going to pay as much for this. Of course I'm not going to. And that's the dip. That's the involves with value investing. That is what's involved here, is understanding where are these numbers going, where are they coming from. So for everybody out there who says, I don't understand growth, you are absolutely incorrect. This is exactly the understanding of growth. Because I see growth here, I don't see growth here, even though the profit numbers are exactly the same overall.
Paul, the second phase of this, which I'm finding the more and more research I do, Warren Buffett, some of the top investors, is downside risk. I never see this, and maybe you don't either if you're watching at home. And a lot of other YouTubers, they always just talk about how everything is going to go up, everything's growing, everything's phenomenal. And it seems like these really, the greatest investors have the downside in mind prior, as opposed to thinking of the upside. It's almost more important to think how much they can lose as opposed to how much they can win.
So one of the dumbest people of all time is a guy named Grant Cardone. I mean, literally this person is the stupidest person I've ever heard on the internet. I wish I could take his head and slam it in that Tesla car door because of how stupid he is. I might make him smarter by doing that. So Grant Cardone says 6% is better than 0. He's absolutely wrong there. It's absolutely not the case. What if the 6% had a 75% drawdown possibility? It could drop by 75%. So you buy an asset for $1,000 and it pays you $60, but it could go down to $250. Versus 0% makes you 0, but the drawdown is 0. Which one's safer now? I look at it going, wait a second, I don't want to lose that 75% possibility. This is an exaggerated example, but the whole key here is understanding your downside risk is most important. I always tell people, I am perfectly fine matching the market's return. Because with our method of value investing, it'll come with a lot less risk. So you ask me, Paul, would you rather make 10% your way or 10% in the market? I'd rather make it my way. Why? Because my downside risk and my value investing method is way lower than this one. The market right now is at insane valuations, but I think over the next 30 or 40 years, you'll get pretty close to 10% returns on your money, right? But I look at my method going, I didn't get 10% return on my money with a lot less downside risk. Why is that not better? And that's the Ben Graham way of investing, is find the companies with a lot less downside risk because they have so many assets in his method, so many assets. In my method, it's more which companies are just being undervalued by the market because they're not sexy enough, because they're not fun, they're not exciting, they're not growing a ton. I'm okay with no growth. I'm okay with very little growth as long as I pay the appropriate price for that. And the great thing about math is it will tell you what you need to pay to get whatever desired return you want. And we can do that in our stock analyzer tool that's in our software for 80 cents a day.
Yeah, Nate, if you show our software, we just did a video on Curate Retail. This is the Everything Money software. You can get access to this as a patron. You get all the financial information. You get the balance sheet, everything you need to pay a lot more for from wide charts. You can get from us, and the stock analyzer tool can help you define what you want to pay for current stocks. This is incredible. It's in every one of our videos, and as a patron, you get this. And Paul, I think if you're at home watching, you will hear more about Benjamin. The more research you do, you will hear about this family tree, this lineage of value investors, Paul. In every book I read, more books I read about it, they sound a lot like you. And
we all sound the same. That's the
true.
thing.
Yeah.
All these value investors, and the great thing is, a lot of these ideas I came up with overthinking, and then you read somebody like Howard Marks going, oh my God, that's exactly what I think.
Yes.
And it's always a joke amongst my friends saying, oh, here we go, Paul's it. But the joke is, we all think the same because we all have the same thought process. And we might talk about something, a totally different category none of us ever talked about, but all the ideas are the same.
That's our take on Benjamin Graham, value investing. We'll continue to talk about it. Paul, you've really opened my eyes. And Mo, too, just really opened my eyes over the past 2 years about more disciplined, careful investing. I feel much more at peace choosing really well thought out companies.
Of course.
Using metrics and math. And just keep asking yourself, if you're watching other videos out there and trying to learn about investing, ask yourself, when these people make these wild massive stock price predictions. Just ask yourself why. And if the math is not making sense.
And they point at a 1/4 analyst expectation and say,
That's right.
see, it's growth. I'm like, okay.
If this is not making sense to you, come on over and join our team, and you'll start understanding this a lot better. So that's our take. Fondle the thumbs up on the way out. Just tickle it like you tickle Paul's belly. And keep following along. Everything Money. Thanks, guys.